Chapter 1, Introduction. Tariffs as economic and market catalysts. Tariffs, defined as taxes imposed on imported goods, occupy a dual role in international economics. They not only serve as a source of revenue for governments, but also function as instruments to protect domestic industries from the pressures of foreign competition. The historical use of tariffs in the United States illustrates this dual function. In the early years of the Republic, tariffs accounted for over 90% of federal revenue, funding critical infrastructure projects like roads and canals. Over time, their role evolved to encompass shaping and influencing modern trade policy. For example, the McKinley Tariff of 1890, which raised tariffs on imported goods to nearly 50%, is often cited as a contributing factor to the Panic of 1893. However, historians debate its role, with some attributing the panic more to railroad failures and bank panics. This historical example underscores the complexity of tariff policies and their potential unintended consequences. More recently, the Trump administration's implementation of tariffs between 2017 and 2021 brought tariffs back into the forefront of economic discussion. These tariffs, such as the 25% levy on steel and 10% on aluminum, were implemented with the stated goals of reducing the U.S. trade deficit, protecting domestic industries, and pressuring trading partners like China to adopt fairer trade practices. In March 2025, the U.S. implemented tariffs of 25% on most Canadian and Mexican imports, 10% on Canadian energy, and 20% on Chinese imports, marking a significant shift in trade policy. These tariffs, reminiscent of the Trump administration's approach, have reignited debates about their economic and geopolitical implications. 2. The U.S. economy and indices in 2025. To understand the potential impact of renewed tariff policies, it is crucial to examine the condition of the U.S. economy. A relevant comparison is between the economic baseline of 2016, prior to the Trump administration's tariffs, and the projected state of the economy in March 2025. In 2016, the U.S. economy experienced moderate GDP growth of 2.2%, with unemployment at 4.7% and inflation hovering around 1 to 2%. By March 2025, economists project that renewed tariffs could reduce GDP growth to a range of 1.7% to 2.3%, reflecting significant uncertainty in the economic outlook. Inflation is projected to rise to 3%, while trade deficits are expected to worsen, with January 2025 data showing a deficit of $131.4 billion, up significantly from December 2024. Key economic indicators such as GDP growth, unemployment rates, inflation levels, and trade deficits provide a framework for this analysis. Moreover, tariff policies have the potential to induce heightened market volatility. Therefore, assessing the potential for increased volatility is essential in evaluating the broader economic consequences of tariffs. 3. Global context. The implications of tariffs cannot be analyzed in isolation, as global economic conditions play a significant role in shaping their impact. China, which accounts for approximately 18 to 19% of global GDP, plays a critical role in shaping global trade dynamics. Slowing economic growth in China could reduce demand for U.S. exports, amplifying the negative effects of tariffs. Similarly, trade tensions within the European Union, such as Brexit-related disruptions, could further destabilize global markets and complicate U.S. trade negotiations. The interconnectedness of global trade and the intricate web of global supply chains further emphasize the importance of considering the international context. 4. Book Roadmap. This article aims to provide a comprehensive analysis of the effects of tariffs on the U.S. economy and stock market. It is structured to provide historical context, analyze current impacts, and offer insights into potential future outcomes. Chapter 2 examines the pre-2017 economic and market landscape, highlighting the vulnerabilities that set the stage for tariff policies. Chapter 3 analyzes the Trump administration's tariff policies from 2017 to 2021, focusing on their economic and geopolitical impacts. Chapter 4 explores the potential revival of tariffs in 2025, including their immediate effects on inflation, employment, and market volatility. By examining historical precedents, evaluating recent policy decisions, and forecasting potential scenarios, this book seeks to offer a thorough understanding of the complex relationship between tariffs, economic performance, and market dynamics. Chapter 2: Pre-2017 Economic and Market Landscape. The U.S. economy before 2017. 1. Post-2008 recovery. A cautious expansion. The U.S. economy experienced moderate but steady growth from 2010 to 2016, with GDP averaging around 2.2% annually. This growth was primarily fueled by increased consumer spending, which accounted for approximately 70% of GDP, and a gradual recovery in the housing market following the subprime mortgage crisis. However, business investment remained relatively subdued, reflecting uncertainty about the economic outlook and regulatory environment. 2. Jobs, a mixed picture. The U.S. saw consistent job creation during this period, with the unemployment rate falling from a high of 10% in 2009 to 4.7% by the end of 2016. Much of this job growth was concentrated in the service sector, while manufacturing employment continued to decline. Between 2000 and 2016, Ohio lost nearly 30% of its manufacturing jobs, while Michigan lost over 35%. These losses had a disproportionate impact on communities that had long relied on manufacturing jobs as a source of economic stability, creating a sense of economic anxiety and resentment. 3. Trade deficits, a structural imbalance. The U.S. experienced persistent trade deficits, averaging around $500 billion per year. These deficits reflected a structural imbalance between U.S. imports and exports, with the U.S. importing significantly more goods than it exported. The trade deficit with China was particularly large, accounting for a significant portion of the overall deficit. Exchange rate issues, and the increasing reliance on global supply chains, were key factors contributing to the trade deficit. 4. Globalization's influence, a double-edged sword. Globalization played a significant role in maintaining economic stability during this period. The influx of cheaper imported goods helped to keep inflation in check, benefiting consumers. However, this also put downward pressure on wages for some U.S. workers, particularly in manufacturing. For example, imports from China were estimated to have reduced consumer prices by approximately 0.2% per year during this period. But they also contributed to the loss of manufacturing jobs and wage stagnation in regions like the Midwest. 5. Rising income inequality. Income inequality had been on the rise, with the Gini coefficient increasing from 0.397 in 1990 to 0.482 in 2016. Trade policies, particularly those that incentivized offshoring, disproportionately affected manufacturing workers, contributing to wage stagnation for middle and lower income groups. Stock market trends pre-Trump. 1. Key indices performance, Obama era. A bull market fueled by globalization. The S&P 500 demonstrated consistent gains, rising by over 180% from its low point in March 2009 to the end of 2016. This performance was driven by a combination of factors, including low interest rates, quantitative easing by the Federal Reserve, and strong earnings growth by multinational corporations. The Dow Jones Industrial Average showed steady growth, more than doubling in value over the same period. The Dow Jones Industrial Average's strong performance reflected the resilience of U.S. industrial companies and the recovery in the manufacturing sector. The Nasdaq, driven by technological innovation and globalization, outperformed other major indices, rising by nearly 300% from 2009 to 2016. This reflected the growing importance of technology companies in the U.S. economy and the increasing global reach of these companies. 2. Market dependency on global trade. The stock market's performance was heavily reliant on global trade. Companies with significant international exposure, such as Apple, Microsoft, and General Electric, accounted for a disproportionate share of market gains. This made the stock market vulnerable to disruptions in global trade flows or changes in international trade policy. 3. Consumer confidence, lingering concerns. Despite the post-2008 economic recovery, consumer confidence remained below pre-crisis levels for several years. Lingering concerns about job security, slow wage growth, and the rising cost of healthcare and education contributed to this cautious outlook. Domestic vulnerabilities exposed. 1. Trade imbalances, a source of economic and political tension. Trade imbalances, particularly with China, created a sense of economic insecurity among some segments of the population. This contributed to a political climate in which protectionist trade measures, such as tariffs, gained traction. The U.S. Trade Representative identified nations with significant trade imbalances, including China, Japan, and the European Union, as key targets for potential policy changes. 2. Manufacturing decline. The loss of American jobs and industries. The decline in manufacturing jobs, driven by automation and offshoring, had a profound impact on communities across the U.S., particularly in the Rust Belt. Between 2000 and 2016, manufacturing employment fell from over 17 million to around 12 million, creating economic anxiety and resentment in regions that had long relied on manufacturing as a source of stability. Setting the stage for tariff policies. The inevitable clash of ideologies. The pre-2017 economic and market landscape was characterized by a combination of steady economic growth, a booming stock market, and growing domestic vulnerabilities related to trade imbalances and manufacturing decline. These vulnerabilities created a political climate in which protectionist trade measures, such as tariffs, gained traction. As Chapter 1 discusses, trade can cause economic division, and the perception that globalization had benefited some segments of society at the expense of others fueled a backlash against free trade policies, setting the stage for the implementation of tariff policies in subsequent years. The debate over the causes of trade imbalances and manufacturing decline reflected differing views on the appropriate role of government intervention in the economy. Chapter 3, Trump's Tariff Policies, 2017 to 2021. A new approach to trade, setting the stage. From 2017 to 2021, the Trump administration implemented a series of tariff policies that marked a significant departure from decades of U.S. trade policy. These policies were driven by the belief that the U.S. had been disadvantaged by unfair trade practices and that tariffs could be used to level the playing field, protect domestic industries, and encourage other countries to negotiate more favorable trade agreements. Furthermore, these policies were rooted in a more nationalistic vision of trade, prioritizing domestic interests over global cooperation. The administration believed countries around the world would face new reciprocal tariffs from the U.S. starting April 2. With President Donald Trump and other administration officials often saying something along the lines of, "Whatever they charge us, we'll charge them." The Trump administration's perception of unfair trade practices was rooted in the following: higher tariffs by trading partners. The U.S. perceived that other countries imposed higher tariffs on U.S. goods than the U.S. imposed on their goods. Non-tariff barriers. The US felt that some countries use non-tariff barriers, for example, regulatory hurdles, subsidies, to unfairly restrict US exports. Intellectual property theft. The US accused some countries, particularly China, of stealing intellectual property from US companies, giving them an unfair competitive advantage. Steel and aluminum tariffs, 2018. An assertion of national security policy specifics and economic intent. In March 2018, President Trump imposed tariffs of 25% on steel imports and 10% on aluminum imports, citing national security concerns under Section 232 of the Trade Expansion Act of 1962. The rationale was that a healthy domestic steel and aluminum industry was essential for national defense. The intent was to revitalize U.S. steel and aluminum production, create jobs, and reduce reliance on foreign suppliers. Market reactions. The announcement of these tariffs triggered significant volatility in the stock market, particularly for industrial stocks. Steel companies like Nucor and U.S. Steel saw their stock prices surge, while companies that relied on steel and aluminum imports, such as automakers and manufacturers, experienced a decline. The tariffs also led to higher prices for steel and aluminum, increasing costs for businesses that use these materials. Economic effects. The steel and aluminum tariffs had a mixed impact on the U.S. economy. While they did lead to increased production and employment in the steel and aluminum industries, they also increased costs for downstream industries, such as automakers, construction companies, and manufacturers. 3. Some studies estimated that these tariffs resulted in a net loss of jobs in the U.S. economy. For example, a 2019 study by the Peterson Institute for International Economics estimated that the steel and aluminum tariffs cost the U.S. approximately 75,000 jobs. A 2018 study by Trade Partnership Worldwide, LLC, projected that the tariffs would reduce U.S. GDP by $9.3 billion annually. Mitigating negative impacts. To address the negative effects of the tariffs, policymakers could consider targeted support for affected industries and workers. For example, retraining programs and financial assistance could help workers displaced by job losses in downstream sectors. Additionally, fiscal policies such as tax cuts or increased government spending could stimulate economic activity and offset the higher costs imposed by tariffs. The U.S.-China trade war, a protracted economic battle. Timeline. The U.S.-China trade war began in 2018, with the U.S. imposing tariffs on $50 billion worth of Chinese goods, and China retaliating with tariffs on U.S. exports. Over the next 2 years, the trade war escalated, with both countries imposing tariffs on hundreds of billions of dollars worth of goods. By 2019, the U.S. had imposed tariffs on approximately $550 billion worth of Chinese goods, while China had imposed tariffs on approximately $185 billion worth of U.S. goods. In January 2020, the U.S. and China signed the Phase 1 deal, which involved China agreeing to increase its purchases of U.S. goods and services by $200 billion over the next 2 years, in exchange for the U.S. reducing some of its tariffs on Chinese goods. Market impacts. The U.S.-China trade war had a significant impact on the stock market. For example, the S&P 500 dropped by approximately 6.2% in 2018, in part due to concerns about the trade war. The trade war also led to increased volatility in the market, as investors reacted to each new escalation or de-escalation of trade tensions. Economic effects. The U.S.-China trade war had a significant impact on the U.S. economy. While the Trump administration argued that the tariffs would reduce the trade deficit and encourage companies to bring manufacturing back to the U.S., studies suggest that the trade war actually had a negative impact on U.S. GDP growth, employment, and consumer welfare. For example, A 2019 study by the Federal Reserve estimated that the trade war reduced U.S. GDP growth by approximately 0.3% in 2018 and 2019. A 2020 report by the Congressional Budget Office, CBO, estimated that the trade war would reduce U.S. GDP by 0.5% by 2020. 4. Impact on specific sectors. Agriculture. The agriculture sector was particularly hard hit by the trade war, as China imposed retaliatory tariffs on U.S. agricultural products, such as soybeans and pork. U.S. soybean exports to China fell sharply, leading to lower prices and reduced income for U.S. farmers. Technology. The technology sector was also affected by the trade war, as tariffs increased the cost of imported components and disrupted supply chains. This led to higher prices for electronic devices and reduced profits for U.S. technology companies. Mitigating negative impacts. To address the negative effects of the trade war, policymakers could consider reversing or rolling back tariffs, particularly in sectors like agriculture and technology. Additionally, international cooperation through organizations like the WTO could help resolve trade disputes and reduce retaliatory tariffs. Fiscal policies, such as subsidies for affected farmers or tax incentives for technology companies, could also provide relief. USMCA and minor adjustments. Replacing NAFTA. Replacing NAFTA. One of President Trump's key campaign promises was to replace the North American Free Trade Agreement, NAFTA, which he argued had been detrimental to U.S. workers and businesses. In 2020, the U.S., Canada, and Mexico signed the United States-Mexico-Canada Agreement, USMCA, which replaced NAFTA. The USMCA included provisions on labor rights, environmental protection, and intellectual property, as well as new rules of origin for automobiles. Economic/market effects. The USMCA had a relatively limited impact on the stock market. While some industries, such as the auto industry, saw some gains as a result of the new rules of origin, the overall economic impact of the agreement was modest. 2. Economists estimated that the USMCA would increase U.S. GDP by less than 1%. 2. Overall, the USMCA brought more economic parity in a market that was unbalanced with NAFTA. Mitigating negative impacts. While the USMCA's impact was modest, future trade agreements could aim for more balanced trade relationships and include provisions to avoid the negative consequences of tariffs. For example, agreements could focus on reducing non-tariff barriers and fostering cooperation on global issues like climate change and technology standards. Connecting the dots, tariffs and the pre-2017 landscape. The Trump administration's tariff policies were directly influenced by the economic and market conditions that prevailed before 2017. As discussed in Chapter 2, trade imbalances and manufacturing decline had created a sense of economic insecurity among some segments of the population. The Trump administration capitalized on this sentiment, arguing that tariffs were necessary to level the playing field and protect American workers and businesses. These policy decisions were not universally praised, as analysts worried that the economic actions were actually impeding the economy. Chapter 4, Tariffs in 2025. Resurgence, Specifics, and Assumptions. Revival of Trump-era policies, setting the stage. As of March 2025, the potential revival of Trump-era tariff policies is looming on the horizon, based on observed trends and policy signals. This chapter outlines the specific assumptions and potential details surrounding these tariffs, as well as an analysis of their immediate economic and market impacts. These actions are set to take effect on April 2nd, which President Trump has declared as April 2nd deadline to be Liberation Day for the U.S., Bloomberg reported. Assumptions. Direct revival. The assumption is that the policies under consideration in 2025 are a direct revival and potential escalation of the trade policies enacted during the Trump administration from 2017 to 2021. Economic nationalism. The core principles of those policies are assumed to remain intact, based on a belief in protecting domestic industries, reducing trade deficits, and leveling what is seen as an unfair playing field in international trade. Policy details. Extensions and escalations. The potential tariff measures in 2025 involve several key aspects. Extensions of previous policies. An extension of tariffs imposed on steel, 25%, and aluminum, 10%. Reciprocal tariffs. A stated intention to impose so-called reciprocal tariffs to match the duties charged by other countries, specifically targeting nations with persistent trade imbalances with the U.S. The administration is now focusing on applying tariffs to about 15% of nations with persistent trade imbalances with the U.S., a so-called Dirty 15, as Treasury Secretary Scott Bessent put it last week. Those nations, which Bessent said account for most of the U.S.'s foreign trade, will be especially hard hit with higher tariffs, said people with knowledge of the matter, though other nations could be given more modest tariffs as well. The White House had previously considered grouping trading partners into 3 tiers of high, medium and low tariffs but has abandoned that plan. Potential targets. It is expected the nations impacted by the tariffs are laid out by the U.S. Trade Representative in a Federal Register notice last month, which directed commenters to focus on nations with trade imbalances with the U.S., such as the G20 nations and Australia, Brazil, Canada, China, the European Union, India, Japan, South Korea, Mexico, Russia, and Vietnam. Sector-specific tariffs. Those sector-specific tariffs, however, are now not likely to be announced on April 2, said an administration official, who said the White House is still planning to unveil the reciprocal tariff action on that day, though planning remains fluid. The focus of the reciprocal action now looks to be more targeted than originally thought, according to people with knowledge of the planning, though it will still hit countries that account for most of the U.S.'s imports. The fate of the sectoral tariffs, as well as tariffs on Canada and Mexico that Trump said were justified by fentanyl trafficking, remains uncertain. 3. The White House didn't respond to requests for comment on if or when any of those tariffs are still planned to go into effect. Immediate impact analysis. Sector specifics and economic indicators. The immediate impact analysis of these potential tariffs focuses on several key areas. Market instability. As of March 2025, heightened volatility in key market indices, as investors and policymakers digest the economic and market uncertainty driven by tariff policies. One Fortune 500 CEO said April 2 can't get here fast enough. Economic consequences. The Trump administration has promised that countries around the world will face new reciprocal tariffs from the U.S. starting April 2. With President Donald Trump and other administration officials often saying something along the lines of, "Whatever they charge us, we'll charge them." Economists said that this is a tit-for-tat strategy and is an effective trade policy. Potential retaliation. The action may cause other nations retaliate the tariffs. It is expected if the U.S. imposes tariffs on goods and imports, there will be reciprocal taxes to offset this. Impact on domestic industries, automobiles, pharmaceuticals, and semiconductors. It is difficult to assess the situation since it is changing so quickly, but the administration may still enact or include sectoral tariffs. And if so, this will have additional impacts on the industries, as well as the consumers buying the products from the industry. Agriculture. If reciprocal tariffs are imposed, countries may retaliate by imposing tariffs on agricultural products from the U.S. For example, China could impose tariffs on U.S. soybeans, corn, and other agricultural goods, as it did during the previous trade war. Steel and aluminum. The extension of tariffs on steel and aluminum has the potential to cause companies that rely on the raw materials If the companies that are reliant on the tariffs cannot find alternative, their business may be in jeopardy. Employment shifts. With the goal of increasing jobs, President Trump and other administration officials often said something along the lines of, "Whatever they charge us, we'll charge them." If unemployment increases, the tariff policies could have a counter effect, and may affect the US's most significant trading partners to levels not seen in decades. And people with knowledge of the planning said that targeted nations can expect to receive significantly higher tariffs. A 2019 paper written by economists at the Federal Reserve and Columbia and Princeton universities estimated that the 2018 tariffs led to declines in real income and increases in prices for U.S. consumers, with the cost borne almost entirely by domestic consumers. The path forward. The White House feels there is no way to avoid reciprocal tariffs ahead of April 2nd. And analysts suggest these are tit-for-tat strategies or policies. While the tariffs have the potential to generate financial gains, the effects of the tariffs also affect all sectors such as global economy. In particular, the reciprocal tariffs and sector-specific tariffs that will have to be addressed soon. Chapter 5: Economic Impacts of Tariffs. Introduction. This chapter assesses the likely economic impacts of renewed tariff policies in 2025, focusing on GDP, trade balances, employment, manufacturing, inflation, and consumer costs. Effects on GDP. Overall impact. The imposition of tariffs in 2025 is expected to have a negative impact on U.S. GDP growth. Analysis. The tariffs may well not increase GDP, as it may well offset any increase. One of the economists' main concerns is how the tariffs will change supply and demand. Tit-for-tat strategy is an effective trade policy. Also, economists worry how much economic output will decline if there is an increase in tariffs. Specific impact. In a 2024 publication, the Congressional Budget Office stated that an increase in tariff of 15% could decrease U.S. GDP by 0.5%. This can change depending on the sector, with some sectors being affected greatly. The CBO has also said that in response to the new tariffs, businesses may pass on the costs and/or reduce overall wages to stay in business. Effects on domestic trade balances. Intended outcome. A primary goal of the 2025 tariff policies is to reduce the U.S. trade deficit by making imports more expensive and encouraging domestic production. Likely reality. President Trump says reciprocal tariffs will kick in on April 2nd, when the U.S. will match the higher tariffs other countries impose on the U.S. The economists explain that this is a tit-for-tat strategy and is an effective trade policy. Also, one economist has said there is no easy way to win these tariffs, and they will likely cause more damage. Multiple trade partners aren't likely going to be receptive to President Trump's new trade policies. The economist went on to say how they know those countries and their plans, because they are a known quantity. The U.S. feels it will have the strongest hand, one foreign official said last week, if everyone is on a burning platform as talks happen. With President Trump's policy, there will be a heavy imbalance of tariffs between countries. The trade imbalances could be greater at an average of almost $600 billion. That could mean the United States may need to consider more negotiations with other nations and work on establishing plans that ensure the global trade markets won't fall. Effects on employment. Mixed outcomes. The impact on employment is expected to be mixed, with potential job gains in some sectors offset by losses in others. The tit-for-tat policy, or whatever they change us, we change them, isn't an effective trade policy. Some economists agree. These new types of trade policies will create more harm. Specific sectors. The steel and aluminum industries could see some job gains as a result of tariffs, although the jobs will be reduced from the price increase. A 2019 paper written by economists at the Federal Reserve and Columbia and Princeton universities, estimated that the 2018 tariffs led to declines in real income and increases in prices for U.S. consumers, with the cost borne almost entirely by domestic consumers. As one official close to Trump noted, this move can be affected by political shifts as well, and his decision to impose tariffs could change. Effects on manufacturing potential boost. A key objective of the 2025 tariffs is to revitalize the U.S. manufacturing sector by making imported goods more expensive and encouraging domestic production. Conflicting factors. A lot of manufacturing is automated to save money. These benefits can be offset by tariffs and higher prices. The prices will increase as these are incorporated. One survey has noted that it is not likely to go as smooth as many may want it to, as the price will increase as these are incorporated. Domestic production. Some industries will move jobs to the U.S. and create an increase in domestic operations. The tariffs are unlikely to affect manufacturing employment as economists have hoped for. Multiple lobbyists representing Fortune 500 clients have called White House officials looking for a path to getting exemptions, according to people familiar with the calls. However, Trump said he wouldn't want to grant exemptions on tariffs. A White House official disputed that description of the meeting, saying tariffs didn't come up. Effects on inflation and consumer costs. Inflationary pressures. The imposition of tariffs is expected to put upward pressure on inflation by increasing the cost of imported goods. These costs are likely to be passed on to consumers in the form of higher prices for a wide range of goods and services. Expert analysis. A lot of the inflationary pressure in the past few years have been caused by tariffs, especially on China. A survey stated that there were increases in the import prices of goods of 20% with the increase in tariffs. In June 1991, the Congressional Budget Office testified that the quotas on steel imports cost consumers about $3 billion a year. The prices of materials have jumped significantly. Consumer costs. A recent survey stated that the households in America overall will face a 1 to 3% cost for tariffs. While the Trump administration's plan is about to be put in place, there will still be additional trade action on other countries. A survey that was taken stated that 40% of the low-income families who rely on government subsidy may see prices on things such as milk increase. The president can look to help fix this, but that is not a given. He can decide to keep it how it is. Quantifying the impact. Depending on the tariffs put in place, estimates can increase between 1 to 3%. In the 1990s, the Commerce Department concluded that tariffs cause U.S. consumers to spend about $70 billion a year in higher prices. With tariffs increasing, there has already been an issue with supply chains and consumer relations. The distributional affects lower income households. If tariff prices are put in effect and are a higher rate than current, lower income people may not be able to afford to buy certain goods. A survey stated low-income families spend an average of 30% of their income on tariffs. It is also shown that the prices greatly are impacted in this population, showing that in recent years it rose almost 7%. If there is an increase in tariffs, low-income people will struggle more. Consumers. While there has been an increase in prices already, the trend will likely continue the same, but may see bigger increases in some items. The price will increase as the business has to take into consideration tariffs to make money. As with tariffs, they may not get the savings they hope for as well. The businesses in America will likely not take a decreased income from the tariffs and will pass those to the consumers. It has already been noted with the threat of tariffs, business may not lower prices. The lower-priced businesses won't have those resources to keep their prices down, as the bigger businesses have. This can in turn cause those smaller businesses to increase their prices as well. Long-term dynamics. It is essential to have policies for global disturbances to help American companies. Analysis of unintended consequences. Trade relations. There is the risk of retaliation with the U.S. imposing tariffs on certain goods and imports. If this happens, there could be trade instability throughout the globe. The economy. The administration's shift comes after weeks of tough talk with trading partners and U.S. industries alike. The threat from tariffs can be high. In the short term, the cost of prices will overall affect the economy. One analysis, written by David Baverly, said that this could affect everyone. The policy goals. The main goal for implementing tariffs is to reduce what the United States owes in debt. By leveling trade markets and implementing reciprocal tariffs, there is an opportunity for debt alleviation for the U.S. Multiple lobbyists representing Fortune 500 clients have called White House officials looking for a path to getting exemptions, according to people familiar with the calls. There have been economic analysts who have said in prior years, what does it take to protect our economy? It is essential to continue to protect the U.S. companies, said John Adams. Although there are some economic benefits to tariffs, most economists feel that the bad will overshadow the good, and say that it causes higher process, a reduction in production and even job layoffs. Chapter 6, Stock Market Reactions. Introduction. This chapter analyzes the likely stock market reactions to the potential tariff implementations in 2025. Introduction. While the imposition of tariffs is expected to create economic uncertainties, it is important to assess both the potential risks and opportunities for investors and policymakers. The chapter evaluates the performance of broad market indices during tariff events, the impact on volatility trends, and shifts in domestic investor sentiment. Broad market indices performance during tariff events. Overall expected impact. While the implementation of tariffs is likely to create short-term volatility and downward pressure on broad market indices, the long-term effects may be more nuanced. Historical data suggests that markets often recover from initial shocks as investors adjust to new trade realities. The initial negative impact on broad market indices is estimated to be between 5% to 10%, but this could be mitigated by proactive policy measures and investor strategies. S&P 500. Based on historical reactions to tariff announcements, the S&P 500 could experience a short-term decline of 5 to 10%. However, sectors less reliant on international trade, such as utilities and healthcare, may provide stability. Additionally, companies that adapt quickly to new trade conditions could emerge stronger, potentially offsetting some of the initial losses. Analysis from previous tariff events suggests that for every 10% increase in tariffs, the S&P 500 experiences a 0.3 to 0.5% decrease. While this indicates sensitivity to trade policies, it also highlights the potential for recovery as markets adjust. Sectors heavily reliant on international trade, such as technology and consumer discretionary, are likely to be most affected in the short term. However, these sectors may also benefit from increased domestic investment and innovation, as companies seek to reduce their reliance on global supply chains. Dow Jones Industrial Average. The Dow Jones Industrial Average, with its focus on industrial stocks, may experience volatility, but the impact could be more muted than on the S&P 500. Some domestic manufacturing companies may benefit from tariffs, particularly those that rely less on imported materials. Companies that rely on imported materials are likely to face challenges, but those with strong domestic supply chains could see gains. For example, companies like Nucor and United States Steel may benefit from increased demand for domestic production. Nasdaq. The tech-heavy Nasdaq is expected to be particularly sensitive to tariff policies due to the sector's reliance on global supply chains. However, The tech sector's resilience and ability to innovate could help mitigate some of the negative impacts over time. Companies listed on the Nasdaq may face short-term challenges, particularly those with significant import operations. However, the sector's focus on innovation and adaptability could lead to long-term growth opportunities, especially as companies diversify their supply chains and explore new markets. Sector-specific impacts, potential winners. Tariffs could benefit domestic manufacturers and companies focused on domestic production. Sectors such as steel, automotive, and heavy machinery may see increased demand, potentially boosting stock prices for companies like Nucor and United States Steel. Potential losers. Sectors heavily reliant on international trade, such as technology and consumer discretionary, may face short-term challenges. However, these sectors could also benefit from increased domestic investment and innovation. Mixed outcomes. The long-term effects of tariffs on the economy are uncertain, but there may be opportunities for new negotiations and trade agreements that could benefit certain sectors. For example, the automotive industry could see changes in trade dynamics that lead to new growth opportunities. Volatility trends and domestic investor sentiment shifts. Volatility trends. The imposition of tariffs is likely to lead to increased volatility, as measured by the VIX. However, volatility can also create opportunities for investors, who are able to identify undervalued assets and take advantage of market fluctuations. While the VIX could spike to levels above 30, reflecting heightened investor anxiety, this volatility may be short-lived as markets adjust to new trade realities. Investors who remain calm and focused on long-term goals may find opportunities in the midst of market turbulence. Investor sentiment shifts. Domestic investor sentiment is likely to shift towards a more conservative stance in the short term, with investors reducing their exposure to equities and increasing allocations to safer assets. However, this shift may be temporary, as markets stabilize and new opportunities emerge. Flight to safety. Investors are likely to move to safe haven assets, such as gold, treasury bonds, and defensive stocks. While this reflects a cautious approach, it also provides an opportunity for investors to rebalance their portfolios and prepare for future market recoveries. Long-term dynamics. The long-term effects of tariffs on the stock market are difficult to predict, as they depend on a variety of factors, including policy responses, global trade dynamics, and investor behavior. While tariffs may create short-term challenges, they could also lead to long-term benefits, such as increased domestic production, innovation, and the development of new trade agreements. Potential for recovery. Historical data suggests that markets often recover from initial shocks caused by trade policy changes. As companies adapt to new trade conditions, they may find new opportunities for growth, potentially offsetting some of the initial negative impacts. Policy adjustments. Policymakers have the ability to adjust trade policies in response to market reactions. If tariffs lead to significant economic disruptions, there may be opportunities for new negotiations and policy changes that could benefit the market in the long term.